So a lot of talk here about the economy, global economy, U.S. economy. Is it turning down? Is it not? Recession, not recession? I mean, something like people with $4.1 trillion have entrusted their hard-earned wealth to you to manage. How do you manage into a world where there may be a downturn, may even be a recession? How does it affect your decisions?
Yeah, it's a great question. First of all, I would say the tone here, having come here for the past decade, is less depressed than it often is, which is a good sign of hope of what's happening out there in the world. Having come off of the most difficult year for a balanced portfolio, 60-40, whether you were in stocks or bonds or anything in between, it was pretty rough sledding. And so I think everyone's happy that that's behind us and looking forward. And the job of what all of us at JPMorgan do is work on advising clients through the cycle. And so we're going to have lots of boom and bust cycles. You've had a few people on today talking about it. And I think the most important thing is to stay focused on diversification, opportunity, not getting wedded to any one thing that looks like it worked in the past. It may not work in the future. And so we're spending a lot of time on that. I mean, one of the things that really manifested itself through COVID was the problem of home country bias, which creeps into almost everybody's portfolios. And you have to be very aware and conscious of diversifying out of it. So not only home country bias in terms of the stocks and the bonds you buy, but also the currency. And I think it's now a really important time that people think about how to get all of that, the opportunities that they may have missed in other parts of the world, especially parts of the world that are, reopening and making it very interesting.
How about that, China? We have had the development today of Liu He, the vice premier, meeting with Janet Yellen, not too far from here in Zurich, to try to start talking again. What do you project for your investment purposes about what is likely to go on with China, and how hopeful are you that that reopening could really stimulate the world economy?
Yeah, absolutely. Having come back from Hong Kong just a few weeks ago, you can just see the pent-up demand of what's there. People wanting to go in country, people wanting to come out of country to travel around the world. I think the opening up of China, while it will have its ups and downs, it will hopefully be a net exporter of deflation, which would be good for the world, getting all of those kinks out of the system. And really bringing back growth in a positive way. So I'm looking forward to that. I just say, for us at JPMorgan, getting to see our people who are on the ground in China and have been working so hard throughout these many years, of us not being able to travel in, we're really excited about that. We're looking forward to lots of good reunions and the like, but people are really excited. And I think it means a lot of things. The tone that you're hearing from many that are either going in already and or are just listening to some of the conversations here today are really positive about what could be happening. And of course, there's all sorts of negotiations that have to happen to make sure that people do things in the right way, that people work forward to cooperation on a fair and even playing field. And I think that those are the important conversations that have to be had. But now that we can do them in person, it's going to be a hell of a lot more fruitful to be able to do it that way than to try and do these things on some kind of a flat screen where you're not able to have those personal connections that are so important when you're going through these negotiations.
You mentioned the possibility of China exporting deflation. That makes me think about supply chains, opening up some supply chains.
Yes.
More generally, do you think that there is some reassurance on the inflation front? 6 months ago, probably we would have been talking about just inflation. It's still real, it's still out there, but it seems maybe to be coming down some. Do you anticipate freeing up supply chains to actually be a counterweight to the inflation we've seen?
Yes. I mean, it's a funny thing when people say inflation has peaked, or it's not. Inflation is just going to grow slower. We still have, goods and services that are up 15% over the past 2 years cumulatively. And so if you only grow at 4% for the next 2 years, you're going to find yourself at things that are up 25% from where they were before we started this. So that's a lot to digest. And wages have to keep up with that. Savings have to keep up with that. We've had nice cushions, particularly in the U.S. consumer. We bank half the households in the United States of America through Chase, and we can see a lot of the actual data. There's been a nice cushion of days of cash on reserve in people's accounts. But that's depleting, and for the lower income, it looks like that might get back to pre-COVID levels of about 19 days worth of a cash excess. By the time summer comes, that's not a lot of cushion to be able to think about where that money needs to be spent. And when prices continue to increase, you need to have the system in balance. So The Fed is doing its job. Effectively, the Fed funds rate is even higher than what it may appear to be. There's some studies that show that it may be as high as about 6.5% effective in the world, and so the whole world is priced off of fixed income. It's priced off of what is the discount rate you're going to use on future earnings. So that's the most important conversation that we're having. But thankfully, we're having it with yield back. And so, bonds have always been a very important part of the conversation, but with many of them negative yielding for the past several years, it's a much better time to think about bonds in the portfolio and a positive contributor, and so I think we're going to have a better sledding going forward.
Which takes us back to your portfolio. As you say, it's got to be balanced, and you referred to 60-40 before. When you have the discount rate really going up, it favors bonds. Does it disfavor equities? Is this a bad time, actually, to really be doubling down on equities because that discount rate is going to discount your future cash flow?
Yeah, I think most of that's fairly priced in. It's going to depend on where things go on any given day. It also depends on currencies and how you think about that. But most importantly, it depends on profitabilities of companies. So they have to go back to being profitable. You're seeing companies rein it in a little bit. Lots of announcements coming out over the past couple of days. And so on the margin, people are going to be really fine-tuning how that works. And those that continue to show profit and growth for that, they should be rewarded with high PE ratios. And those are the companies you want to invest in for the long term. And this is really about long-term investing. So that's the focus. That's what people have to keep their eye on, and that's what we spend a lot of time doing at JPMorgan.
In your letter this year, you described the growth that you've had at Asset and Wealth Management at JPMorgan, and it certainly struck me. It was substantial growth. You've added a lot of people entrusting their hard-earned money to you. How are you doing that?
No, it's hard work every day. I think the real benefit of JPMorgan Chase is we are on the ground around the world, and we are in touch with what's going on in a way that maybe others are more limited. And I always say it's irresponsible to be investing in today's world if you're just going to do it passively and you're going to sit back and you're going to think that the world's going to take care of it. It's equally irresponsible to think that you can only focus on one part of the world and not think that the whole place is interconnected. You have to understand what's happening in China. You have to understand what's happening in India. It affects the local company you're investing in whatever country that you're living in. And so all of these things are really important, and our insights that we bring to bear for our clients and the opportunities that we can present them with, whether it's in the public markets, in the private markets, lots of climate tech opportunities. Just there's an enormous amount of things that people are passionate about wanting to invest in, and I think that's an exciting time for us.
You mentioned climate tech. As you build your business one client at a time,
yes.
How important is environmental, social, and governance? I mean, is it something that they bring up to you? Do you retain clients that way? Do you lose clients because they're not so enthusiastic about it?
I will say that the letters ESG are not actually directly related with each other. There are three different and important letters, and all three of them are important with different degrees to different clients. And it's our job at JPMorgan to think about how we express a client's desire of where they want to invest, how they want to invest, what's important to them. And we express that through different vehicles in different parts of the world. And I think we do a really good job of that.
Mary, you've been coming to Davos for a while now. What's the biggest difference this year, do you think?
I am shocked that there is no conversation about COVID. I am equally shocked that there's very little conversation about crypto, and there's not even hand-wringing about things like cyber and the like. So I think the worry list is still out there. People have to keep it on the forefront of their minds, and the answer to every question is diversification.